My first gig out of business school was at Wilmington Trust. We had 3 clients, executives, ultra high net worth, die within 18 months of retirement because they
Wow.
had nothing to retire to. The acquisition of wealth is a game. We stay away from people who think of the acquisition of wealth as the acquisition of power. It's not. It's a game to them. What are the rules? Let me exploit them. Let me harvest them. Let me win squarely, fairly, but I want to win. The real
Yeah.
gift of entrepreneurship isn't making money, because there's plenty of entrepreneurs who don't end up making a ton of money, but it's
All right. Hey, everybody. Welcome back to Remnant Finance. We've got our recurring guest here. You're quickly climbing up the leaderboard of most podcast appearance. Welcome back to Ro from the Owner's Asset.
this is my 3rd time, Hans. So I don't know who has been on more, but I will compete for that accolade for sure.
Yeah, I think Joe Withrow has got you beat by 1, but
All right.
yeah, I'm excited for this. We're going to talk about retirement today. I'll give my thoughts on retirement kind of as we go, and I think from the start, my approach is that this is something that is important, but it is not the primary singular focus of financial strategy. In the same way that we talk about rate of return is important, but protection and savings come first, I kind of see retirement as, get life right now, figure out the lifestyle you want now. Don't just set everything off towards retirement and make that your number one priority and your number one goal. Generally, that's where I land with it. But we want to talk about planning for retirement. I think at different income levels would be an interesting conversation. Like, you have a lot of high net worth clients, and so that might look different there, and maybe that's something we can strive for. But also, just what are some of the risks? How do you approach it philosophically? We'll just kind of flow. So first of all, I know you talk about and you think about retirement all the time as a fundamental. Like, where does it fit in a strategy for you?
Well, loaded question. And I think you're right. I want to start with the first thing you said, Hans, was retirement isn't just not working anymore. I think smart, educated, thoughtful people end up with that second phase of life, retiring to something. And I'll tell you, this is totally like not what we discussed, but I worked my first gig out of business school was at Wilmington Trust, as I mentioned to you. And we had 3 clients, executives, ultra high net worth, die within 18 months of retirement because they
Wow.
had nothing to retire to. Do you know who my happiest clients were, Hans, in retirement? The people who got busy with their hands, guys who just took up or returned to being a mechanic or painting. And so the first concept of retirement is, look, you have to retire. So you have to have something to retire to, not something to retire from. So I agree with you 100%. But that ultimately my day job and what I focus on is, I think retirement income planning is the coolest 3-dimensional Rubik's Cube puzzle that you can solve. So let's start with 2 definitions I want to throw on the table, and then you can pick at it and tell me I'm wrong or vice versa. But one is, I love the Morgan Housel Psychology of Money's book. His
Yeah. Great
definition
book.
of retirement is to be able to do what you want, when you want, with whoever you want, whenever you want. Because he's actually talking about freedom, right? Retirement, to most people, conflate the two. Retirement is freedom. And I don't know if people do a good job of realizing that the dialogue they're having with us at their owner's asset, because we are advanced retirement planners and estate planners, is actually about freedom. So that's to your point, is like, I think most people really want freedom. The people who are on the bubble, they are solving for something. For the second definition I want to put on the table, they are solving for, and I wrote this down, you want to make sure you never run out of money. They're solving for surety of money. So we can talk about that, because that is a more quantitative, specific dialogue. And then there's the cool behavioral dialogue. And we'll probably toggle back and forth between the two. So, Hans, those are the 2 ways, the 2 prisms that I think about retirement planning through. One is the acquisition of freedom, and the other is surety of income.
Yeah, I think, yeah, the surety of income side of it that seems to be the main focus and the starting point. And I think that that's pretty well fleshed out. I don't think satisfactory to the typical retirement experience. I think the numbers kind of show that the way that it's treated right now, which is just build a mountain of money and then withdraw, hopefully liquidate 1% of it and hope you never run out. Like that, it kind of lends itself to a scarcity mindset. You spend 40 years accumulating and piling up, and you don't really learn how to spend down, how to withdraw. It's based on an arbitrary age, and I think that there's just a lot of flaws with that model. But let's talk about, because I do think that the philosophical, the freedom element of it, the less quantifiable definition is more interesting and something we should start with. And then we can get into numbers. I think I think that's the more valuable component of it because that's more paradigm changing than the typical conversation.
I think it is more paradigm changing, and yeah, we'll end up at the other side because it is really important to give people, your audience, structures to as to what are some good guideposts. But I've come to my entrepreneurial journey is really begun in the last, kind of 6, 7 years. Before that, I was corporate, and I got to tell you, the philosophical aspect of freedom is what motivates me every day. And I believe the owner's asset is on a mission to re-pensionize America. And I believe that everyone will reach their highest and best use, like nice hedge fund term, right? Their highest and best use when 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 they don't have to worry about money. When you get to wake up and do what's creatively fulfilling for yourself, like you end up actually producing even more. As our business has grown and gotten more stable, our ability to influence and serve and help others has gone up dramatically. Intergalactically better. Advisor than I was just 2 or 3 years ago because yeah, your basic needs are met. That we're achieving that Morgan Housel definition philosophically, and I got to say the wealthy. The well, you mentioned that we work with ultra high net worths, and we typically do. I think we have 5 clients now over 100 million in our stable, and none of them think about retiring or stopping. They think about two things. One, they think of it as a game. It is fun. The acquisition of wealth is a game. Now, here's a big caveat because we love our clients. We stay away from people who think of the acquisition of wealth as the acquisition of power. It's not. It's the acquisition. It's a game to them. What are the rules? Let me exploit them. Let me harvest them. Let me win squarely, fairly, but I want to win. That's the first thing that our clients think about is that it's a game, right? They think of it as a challenge, and I think more people need to take on that mindset. In order to achieve wealth, you have to look at it as a challenge, as something fun to try to do, even if it's iterative, right? The second thing that our wealthiest clients are always talking about and thinking about with us is how much of an impact they can have. I don't know anybody who's done really, really well that wasn't impact oriented. I mean, Elon Musk, the first trillionaire as of a few weeks ago with the IPO, he is genuinely trying to change the world. He's putting some serious coin in his pocket doing it. I don't have a single person in my stable of clients that isn't impact oriented. So they look at challenges differently than everyone else, and they're impact oriented. Those are the two common threads in the folks that we work with.
Yeah, something that popped up when you were talking about how like the challenge is part of the fun, like the wealth accumulation is part of the fun. It kind of made me think of a poker game. I love to play poker, and I think playing poker and sitting with the guys, having a beer, smoking a cigar, and playing poker, like that is fun. When the game's over, even if you win, it's like you could have all the chips in front of you, and it's like, can we keep playing? Like, does anybody want to play another? Can we just start from scratch again? Because it's so fun playing, and then yes, having the chips in front of you is satisfying. I want it, but then it's like, okay, cool. Now I have dollars in my pocket. I convert my chips to a couple $100, couple $1,000, whatever, and now I just have that money. Okay, what do we do next? Like, there's something in there's challenge and enjoyment in the pursuit, but at the same time, I don't want to gloss over the fact that when I think about retirement, fundamentally, I don't like the idea that I'm I'm doing something that I don't like now and I plan to do it for 40 more years until I hit an arbitrary age at 65, and then I get to stop doing that, and then I hope I have enough. It's like both ends of that to me are kind of broken. The kick back and do nothing element, and also the well, do something you enjoy now. And I don't want it to just be as simple as like, well, just change jobs. Like that's not feasible, but at the same
It's
time,
not.
yeah,
Yeah, you're never going to become the best for. See, what is the gift of? You talked about this implicitly on our first episode, the 2 hour and 27 minute
yeah,
one, I think, where we should anyone who watches that full episode, email Hans or email me. I'll send you some microwavable popcorn and a bottle of wine because that thing we just went on. But like, we'll make it fun for folks. You were talking about moving out of the military. Now you found purpose in what you're doing. The real
yeah.
gift of entrepreneurship isn't making money because there's plenty of entrepreneurs who don't end up making a ton of money, but it's who you have to become to be successful is the real goal. And that's what so why are we talking about this in a retirement planning episode? You want to reach your goals financially, focus more on what to become, not what to do. I know that sounds counterintuitive for a quant-oriented financial advisor who's tax forward to tell you that, but we're going to get to the quant here in a second. But like, that's exactly what the mission is. The mission is to focus on what to become, not what to do. What to do takes care of itself. I gotta tell you, stuff comes into your life that you never thought once you become an entrepreneur. There's whole new ecosystems out there of people that you tap into and people that come in and out of your life that change everything for you, like you and I meeting and recording
Yeah.
podcast, Hans, right?
Yep. Yeah, absolutely. The amount of opportunities just from trying this venture, the amount of opportunities that I never would have come across had I stayed in my track of the military. And I think that one thing, here's a little anecdote, but this past weekend, so when we're recording it a couple days ago, was Father's Day, Sunday, and my wife asked me what I wanted to do, and I just said I said nothing. And the reason, and so what I meant was not like I just want to sit and watch golf all day, but as an entrepreneur now, I have this constant stress. Like I can't relax because even though this is much better, it's more fulfilling than the Navy. I make more money than in the Navy. Everything on every metric is better than when I was in the Navy, except for the stress of it, which is motivating. But when the best pilot and the worst pilot in the Navy, no matter how many patches and quals you get paid the same as the worst pilot who's trying to fight a DUI. They still get paid the same as you, right? And so there's no threat there. It's comfort, it's safe, but it's consistent, and I don't have that worry. Now it's like, well, how can I take time to clean my office when if I'm in my office I need to be working on something? How can I just relax? And so I do try to be very intentional about spending time with my girls and not just locking myself in the office. I do spend a lot of time with my kids, but I don't spend a lot of time just doing something around the house. And so I was like, you know what? I want to clean the shed. I need to clean the outside shed. I want to just work out in the yard and do chores. We have a passion fruit bush, just trim that or whatever. Like I want to just do stuff without stressing. And I told my wife at the end of the day, I was like, you know what, that was an awesome day. And she's like, I just feel bad because we didn't do anything. I'm like, yeah, but we do stuff all the time. But like I got so much satisfaction out of just having nothing on the schedule and allowing myself to not feel guilty about not working. And so there was just
You
interesting.
just
Like,
proved the point. Do what you
yeah,
want, when you want, with whoever you want, wherever you want. That's the
yeah,
greatest line of modern psychology of money. So, okay, I want to be clear. What we're not recommending is just go take the entrepreneurial leap to people who are listening, right? Because I did that and it was absolute nightmare financially. But how do you know when you're ready? Let's start getting to some of the numbers, Hans. Is that cool?
yep,
Okay. I've been in the biz, like I said, money management or wealth management for a very, very long time. And I worked at two companies that were planning forward. Let me start by telling you what doesn't work and why it doesn't work. Here it comes. This is the part where you freeze and we turn it into a clip, Hans. Monte Carlo simulations do not work.
mm-hmm, yep,
Okay. What is a Monte Carlo? Okay. Let's start with why it took hold in the industry. It's a statistical analysis, jargon. Basically, all it is it says, let's assume you make 7%, and most of them are run at 7% because that has been the historical rate of return of a 60-40 portfolio. Hans and I both hate 60-40 portfolios. We're not going down that rabbit hole, Hans. I know how much you love rabbit holes, brother.
yeah, yeah,
Okay. But 99 out of 100 people say, well, if my money's going to grow at 7 and I pull 4 out, I'll never run out of money. Is that a good English summary?
yeah. That should be it's
And
intuitive.
it's
It should
very
make sense.
intuitive. It is categorically wrong because you can average 7, spend 4, and run out of money.
Yep, yep,
How? Why? If the 12 months prior or the 24 months after you retire, that 7% return average has down 20, down 16, down 8, any down couple of down years stacked, or even one really nasty down year, you're touching your principal, you're touching your money to live. So now you either got to die sooner or spend less. Neither of those are attractive either. The AUM industry, of which I love and I'm a part of, has done a really good job taking Monte Carlo and saying it's truth or it's fact.
yep.
It's a guidepost. Does not work for true retirement planning. That was a lot. Hans, challenge me, push me, tell me why you agree or disagree, boss.
No, I have no challenges there. In fact, the last week or week before, 2 weeks ago, I had an episode where I kind of rehashed a topic we talked about early on in the podcast. About the average rate of return and how it's a fallacy and it should be meaningless. And to me, if an advisor says that, I walk out. And so the idea that we'll say past performance doesn't indicate future results, but let's look at past performance to project future results. It's like, I don't care what happened over the last 30 years. We just fulfilled the role of a human employee that we were planning to pay $60,000 a year to with a cloud subscription. And we've done, like, we're exceeding everything that we thought we would get out of a human employee. I think everything changes. And so for me, what happened in 1960 to 1990, for instance, that 30-year snippet in the average rate of return, I'm not going to take that average and apply it to the future. I don't believe in taking the past, applying it to the future. I understand, yes, past data has existed. What the future holds, in general, we don't know, but also specifically right now, at such a pivot point, I just think that there's so much uncertainty that I don't want past data to come anywhere near my future planning. And that gets more into the broader overview, like the approach that we take, which is, planning. We're not market dependent. And so, I think that's very accurate that we don't, that Monte Carlo simulations or the Trinity study, which said the safe withdrawal rate of 4%. And then people take that 4% and there's all this debate. Well, is it actually 3.5% or is it 5%? Well, look at the last 30 years. Okay, well, shave off 2 of those and let's look at the last 28. In that case, you could have done 7%. And so are you shortchanging? Like this, the financial independence community gets so hung up on this metric. Then I'm like, to me, that's totally missing the point. It doesn't resonate
you need
even
both. You
remotely.
need both, actually. You can't be all riskless assets too. So that's what's so cool about the
Right.
dialogue I hope to have today. But so, well, by the way, just so people know what to Google and if they're interested in more research, this whole idea that that the order of the returns, the average, anyone can get you 7%. Getting a 7% average is not hard, right? A robo advisor can do it. Indexes can do it. What that's called, where you don't know if you happen to start in a down year or an up year, that's called sequence of returns risk, and that gets thrown around a lot and not discussed candidly properly, but that's what it is. So what are we trying to say? I'm going to do it in a more formal way. Look, there's not a fixed set of outcomes in the markets. There's not. There is a average return, 7, 8, 9 if you're 100% S&Ps, but it's not a fixed set of linearity to it. And so that's what this matters. And by the way, Hans, here's what's so interesting about retirement planning, why I get so excited about it, because I'm a retirement planning dork. Even if the market was, so let's say 7, because I've been anchoring about, or 9, which is close to the S&P, was 9% a year linear, by the way, no down years, no years of 8.9, no years of 9.1. Every year was 9%. Odds people would still run out of money. You
Mm-hmm.
know why? Even if they spend 4 and they got a linear 9, because you can't model human behavior.
Yep.
You can't model a long-term care event if you didn't have that type of insurance. You can't model human behavior. So one, Monte Carlo doesn't work for the way we actually interact with money. But even if it was a statistical truth, it still wouldn't work because you can't, modeling human behavior is impossible. That's why your advisor who's telling that, good, thank you for that. It's a good guidepost. You could have as much as 15 or as little as 2 million if you start with 4 is like a good rule, right? You're still not modeling human behavior. A sibling passes, a business goes under, a kid needs help. You can't model human behavior, man. So that's
And you
kind of the big thing.
make a decision based, like, you purchase a house after a stretch of 3 good years, right? And then everything, like, things change and now you've committed. It's like you've committed to an increased floor of required spending while things are looking good. And then if you hit that sequence of return realm where you have a couple bad years, you don't, if you lock in spending, but everything else is fluctuating around that, you could find yourself in a situation like those are the things that you can't prepare for, or you can prepare for, but you can't fully mitigate because you don't know, like, when you make those decisions, it's just, I don't know, it's not a sound foundation in my mind that you're basing it off of this.
Yeah, you're bringing up 2 really critical points there, I think. And the first is, okay, if you can't prepare for it, well, you need a starting point. If you can't prepare for it, what can be done? So can you, like, make sure I come back to both of those? Because that's where what we don't want to do is cause anxiety for the listener, for your audience, be like, okay, if all is lost, where do I even begin? Because here's what most people do, because everything we've said is completely true. You don't know what the market's going to do. There's sequence risk. There's all these unknowns. You can't model human behavior. So what most people do, and it's categorically wrong, is let me just throw as much as I can at a retirement account and hope it all works out. That's not proper planning either. So let's answer those 2 questions, Hans. Where do I start and what can be done? Let's give people the 2 bookends of how financial planning and the math actually works, okay? So bookend that is the most common is the 4% rule. Cool.
Yep.
So what's the risk? And I'm giving people simple back of the envelope calculations, even though every advisor has software to show you all this. Let's do it in English. Let's get a pencil and let's get a 3x5 note card and model out your retirement today. Cool.
Cool.
4% rule. What's the reciprocal of 4?
Nice.
25.
Oh,
25, right? It's 25 times 4. It's the reciprocal of 4 is 25. And
oh,
so if Hans's goal was to retire at 200K a year, can we use you in today's example?
yeah. So
If Hans believed in the 4% rule, which we just said doesn't work as a Monte Carlo, but he said that's where I believe in, you would need 25 times 200K. So you would need 5 million bucks. Okay, that's that's where we can start. So people can simply say, okay, I want to live off 100K. Let's use 100 because it's easier math, so we don't stump each other. I want to live off 100K, and I believe in markets only. I need 25 times that amount. I need 2.5 million. The other school, the other bookend now, so say, well, I love insurance and annuities, and right now, annuities are paying 7 or 8%, depending on your age. I've seen some annuities go out in the last week at 8.3. Okay, so let's do the same thing. Let's say you're getting 8%, right? It's roughly 12. So if you wanted to live off 100K a year, you would need 12 times that if you annuitize your whole portfolio. That's 1.2 million. Cool, Hans?
yeah. So yeah, you need a lot less if you're going with the income strategy versus.
Right, the distribution-based strategy, the risk-free strategy, versus the 4% rule. We should talk about the pros and cons of each of those schools of thought, but those are good because I don't want people to get frozen. God, all is lost. Monte Carlo doesn't work, right? If your goal is 100K, a bare bones retirement is 1.2 million annuitized. The common financial retirement is 25 times 100, so 2.5 million. The answer is obviously somewhere in the middle, and we're going to get to that. But
But
maybe Hans, it's your show. What pros and cons of each, or what do you want to do?
well, I mean, just comparing those two things in a vacuum, is there a middle? Like, is there a necessary middle ground? Like, if you have two choices, like one of those is so much clearly like getting $100,000 guaranteed without any uncertainty on a corpus of 1.2 million versus getting a possible $100,000 on a corpus of 2.5 million. Like there's no middle ground there necessary, right? Now again, that's just between those two options, but
Massive
you,
middle ground. Good. I'm going to play devil's advocate.
well,
So
okay,
Hans,
there's a middle. Like yeah, you can stack up, you can add in other factors, but if we're just saying what is the best way to have $100,000 a year of income in retirement, I think that's a binary. I don't think we need any middle ground here because why, for the same outcome, why would you not take the guaranteed 100,000 and need to save less than half? Does that like what is the
yeah, great question. And I'm going to say to you, so you're trying to. This is so unfair to you, spectacularly unfair because I've set up a straw man for you. But like you're good, you're the advisor trying to sell me the annuitized path. Let's do some role play here,
all
okay?
right,
Whatever,
all right.
right? My answer to you as an educated consumer is going to be, yep, I need less money to retire. Hans, it makes sense. Annuities' biggest Achilles heel is it doesn't keep up. Typically, they don't keep up with inflation. That fixed income stream. So pensions are COLA, cost of living adjusted, if you have a traditional
Mhm.
pension, but a fixed annuity that's yielding 8% right now doesn't keep up with inflation. So if I retire and lifespans are going up, right? So if I retire at 65 and I have this annuity that you just sold me, Hans, which I would love to do. Look, I would love 10 grand a month or, whatever that is, 8,000 a month coming in. Take ground beef, for example. I was just reading this yesterday. That's why it's top of mind. The price of ground beef in this inflationary spiral upward that we've had is up 312% in the last 8 years, right? It's
Yeah,
11.99 for me, 3 blocks away at the grocery store here in DC,
same.
right? And so that's why. So the all annuities path is wonderful because you have guarantees. You sleep well at night. It's called a swan strategy. Sleep well at night. You just have to make sure you have something in your portfolio that keeps up with inflation. That's the first, right? And
Okay,
two
so yeah,
is,
there's middle
yeah,
ground. Yeah, all right.
you'll need some middle ground. The second reason people don't buy enough annuities, and it plays a critical role, and I will annuitize, and I'll tell you exactly how much and how I'm going to back into that number. But the second reason is an annuity, in all annuities portfolio, because annuities are great, in all annuities portfolio runs counter to the American dream. In all annuities portfolio says you've now frozen your wealth. Growth, that I will always be better off tomorrow than today. The fundamental equation that is the salesmanship of the American dream gets held in abeyance when you buy an annuity with all of your money. Those are the two reasons you don't do it, Hans. Is inflation can devour you. You don't feel it for the first 7, 8, 9, 10 years, but all of a sudden, 15, 18, 20 years into retirement, you really do start to feel poorer, my friend. So that's why.
Can you get an inflation adjust or inflation rider on a fixed annuity?
Absolutely. And then what they do is you don't get that 8%. It starts a lot lower,
Right.
4.5 to
Okay.
5, because then they'll tack on a 4%. And by the way, it's total side note, super cool strategy that we explored for a client who was uninsurable. The grandma and grandpa were uninsurable. They didn't end up going that route, but it was a cool exercise for me to learn is they could buy a joint annuity with them and their grandkids, and the grandkids will get the annuity for life, right? And they put an inflation rider on it, and 40, 50, 60 years later, their grandkids were getting way more income than grandma and grandpa would have as an estate planning, as an income play for the family. So yeah, there's really cool things you can do with annuities, Hans, where you can get an inflation rider, but everything in the world is a trade-off, right? Stocks is a trade-off, risk instead of safety. Safety is a trade-off instead of risk. And so if you did want an inflation indexed annuity, your payment goes down. And yes, you can do 70% of your 1.2 core% fixed and some of it in inflation adjusted. But those are the trade-offs to the school of thought.
Okay. Okay. So yeah. So with in a what is the most efficient way to get $100,000 a year? It's definitely the annuity, but then we add color on top of that, and that is, well, do you want 100 to stay fixed, or do you want that to rise with the tide? And are you going to have other? I like the idea of having for your fixed expenses having an annuity there. I personally counter to a lot of the conventional mindset. Like I think having a mortgage that you're paying and you've locked in, if we think inflation is going to continue, I like the 30-year mortgage as a vehicle to decrease the payment over time. And if you have an annuity payment that matches your fixed expenses, like your mortgage, like other, if you can ballpark your fixed expenses to the nearest, say, $10,000, right, and then have annuities that cover that, well, then you could allocate to that component. Here, this part's covered with the floor, and now for the rest of it, for the discretionary spending, we can
All
have
right.
assets
You
that.
jumped to the middle ground that I was building to. You got to the conclusion of the whole episode,
Oh, that
but
was it.
no, that was awesome. That's exactly how I think people who are well versed in both schools of thought think about it. And we'll get more precision to it. But let's go to the other bookend. That okay, you need 2.4 million to do it our way, right? Or yeah, 25 times one. You need 2.5 million. Sorry, you need 2.5 million. The 25x rule. You you will inflation will not erode your wealth, right?
Mhm.
That won't happen. That major con, but you do have the con of potentially running out of money, right?
Right.
Because retirement planning is actually fundamentally income planning. It goes to the very first thing we said. It's surety of income, and if your portfolio has sequence of returns risk and only sequence of returns risk, right? That whole idea that even though you'll get the average, you don't know the path to the average. It's super bizarre to have to say this, but if you only buy assets that have volatility, you will have volatility in retirement. I
Yeah.
know it's counterintuitive, but
Yeah.
that's what happens. And so, what's the mistake we're both making in this dialogue? Net worth is not a proxy for income.
Yeah.
That's really what we're dancing around, and that's the mistake, and that's being sold by the AUM only side of the house. And I love that side of the house because it creates wealth, and I'm not against it, right? But I want to say that again: net worth is not a proxy for income. That's the most important thing.
That's some. It's funny. I was just thinking. I made that point yesterday on a call with a client, and I said, if you would you take this trade off? Like, let's say right now you could ensure that you'd have, say, $20,000 a month of income, right? You have, and you covering your expenses by more than double with this. So like this is plenty of money. Would you be okay with, like, just conceptually, not that this is a real scenario, would you be okay if your net worth was $0, but you had $20,000 of fixed income guaranteed every month? I would. Well, in that situation, and the point I was trying to make is, like, who cares what your net worth is if you understand what cash flow does for you? Like, I would take a $0 net worth on paper because it doesn't mean anything if I have $20,000 of fixed income every month, right? Like, that's an
Yeah, and
easy
that goes
goal.
back. We just toggled all the way back to the other side as well. Look, if that 20,000 is not inflation indexed, you need something in the middle. But yes, do you want to go into retirement with the largest number or the most income? Obviously, the answer is the most income, but everyone wants the optionality for the number to go up, right? No one wants to take a
Yeah,
step back. And this is fundamentally why I started the dialogue with both sides are right and both sides are missing something, right? Because no one's ever wrong, but both sides are right and both sides are missing something. Here's what happens in the $2.5 million side, in the accumulation side. It's what we talked about. Even if you can guarantee that 7% forever and pull 4%, no volatility, you can't legislate human behavior. Lifestyle creep will happen. Other expenses will show up. Once you have something and enjoy it, you can't go back from it. So they just end up on what's called a hedonic treadmill. And so that's my challenge with that is, one, you have to consume more volatility than you realize, right? Sequence of returns risk. And two, I don't know when enough is enough for those clients. And so those are the challenges of both the sides. So in a high inflationary environment, safety first school of thought has some challenges. A lot of security, sleep well at night, but you worry about an unforeseen event about inflation. The accumulation side does a great job whipping inflation, but then you worry about bear markets. So the answer is obviously somewhere in the middle ones. But that's kind of like my high level summary for people to latch onto of like, okay, I know I need to get started. Now I have these rubrics, the reciprocal of 8 and the reciprocal of 4, to help anchor me on the low and the high end. That's what I'm trying to achieve today, is to show people, if you know your number or your goal, that's how you start the plan. Cool?
Yeah. Now, what the idea of a retirement at 65, the idea of Social Security income kicking in, is like we have a lot of there's a lot of structural there's a lot structurally built around the idea of retirement in your early 60s or at 65. Qualified plans starting at 59 and a half, when you can start taking withdrawals. Social Security income, that window there in your early to mid 60s. It just like, if you just say what's the retirement age, even like insurance companies talk about human life value, it's based off of years till 65 ballpark, right? I think that's clearly a holdover that hasn't changed from a point where people had shorter lifespans, and that was the tail end of your life. At 65, you might have 3 to 5 more years. Obviously, that is no longer a factor. Yeah. And so do you give any merit to 65? Like, let's say you could just wipe your brain of retirement planning and start building fresh. Would 65 ever logically come into the discussion?
No, never, because you want to make sure you're having an impact. And as we've moved, the 65 is rooted in a couple different things, but it was also based on when we had an agrarian or a farming-based society, and that's when you were less productive. And now that we're in a knowledge-based, workforce, 65, you're smartest from 55 to 65. I mean, my father's a 78-year-old doctor and still rocking and rolling. We're putting in place a cash balance plan on a 73-year-old physician, and so. Yeah, the 65 is arbitrary, but people do want to know. I think it is very helpful, though, for people to say, I want to be free by 65. Maybe I don't want to retire. And that's where planning is cool, because planning is where psychology meets the numbers, right? And so to me, saying, I'm going to help you build a plan to be free at 65, then if you choose to work, right? Because I want to be in a position in my life where I'm just choosing which clients and which cases I'm working on, and how I'm deploying my human, intellect to those cases. But yeah, I doubt I'll stop at 65, but I will certainly just work on the most complex, scary, hairy cases I can get my hands on, because I think it's super cool. But yeah, so 65 is irrelevant in a human context. I think it's hyper relevant, Hans, I need something to start the analysis. Because our reciprocal of 8, our 12 and 25 rules are irrelevant if we don't know by what age to get there. So you need to ground the analysis, the forecasting, somewhere, but you don't have to live by it. It's not gospel. But yeah, you got to pick a number. So if a client says, I want to retire by 60, say, great. These are your bookends. Now, how do you want to get there? Let's come up with the plan. That's why the planning is important. Because I don't want to wake up every day and know I'm never getting free on. So let's run the counterfactual. The counterfactual is terrifying. The counterfactual is, I don't have a plan. The counterfactual is, well, if I don't put a stake in the ground at some age, I don't know how much to save, in what vehicles. So no, you got to put an age on it just to get the analysis going.
And people don't typically love their jobs. Like people, more people than not, I think, would look forward to that retirement. So yeah, it's not just that. Like, think about your current role, and can you imagine yourself doing this well into your late 60s? If you can't, well, maybe retirement planning, instead of just let me build a number of dollars, let me build up this pile, and then at age 65 I just turn it all off and stop. Maybe it could be, let me spend some time, yes, building that pile, but also help thinking about and transitioning towards doing something that I actually want to continue doing, like that for the 35-year-old who's just starting to think about it right now, I think doesn't need to feel stress or pressure about age 65. Like, I only have X number of years until 65. It's like, who cares about 65? But if you don't want to do what you're currently doing forever, start thinking about what you could be doing. And then how can we pad the numbers to where you don't have to keep working for full-time income? Make it like, what's your dream part-time job? And now we can start working backwards as to how do I shift towards that. It's like, these are your earning years, but let's make that transition, and let's just remove 65 from this, like, a stress factor.
Two things just happened. This is super cool. And everyone watching can know that this is clearly not scripted because we're just going back and forth. But like, two things happened. Every time you and I have started to give people leadership and guidance on the numerical stuff, we come back to the psychology because that's really what this is. And then you just reprove for the third time in this episode the Morgan Housel quote of what you want, when you want, with whoever, wherever, right? And that's really what this is about. Okay, so where should cutting edge modern planning be and where should it go? You can't be all in on either school of thought. I think we did a pretty good job explaining why. Now, where you are depends on risk tolerance and capital, okay?
Yeah.
Because if you are no longer able to work, you want to live off 100,000 and you have 1.3, guess what? We're putting 1.2 in annuity and 100K into something tied to inflation because you just don't have a choice there, right? Because you're just, for whatever reason, you're not able to, right? How do we think about it, the owner's asset, and what do we design for our clients when we do their detailed retirement planning? You nailed it. You were going to it earlier. You actually said it explicitly, and I dropped this on one of our other conversations together, but I want to make sure food, shelter, and healthcare, including the historically 11.2% healthcare inflation rate, by the way. Healthcare inflation rates in the United States are low double digits. I mean, it's bonkers, right? Are inoculated that if 2008, 2000, the entire rolling lost decade of 1978 to 1960 to 1981 happens, I am going to eat, make sure I'm alive, right? And I have shelter and can see a physician. So, and that, by the way, we talked about the Ernst Young study. So that generally in all the plans that we've done collapses to around 30%. And so, my general guidance to people is, yeah, of your net worth, roughly 30% should be in the safety first school of thought. More if you're conservative or underfunded, but a really good heuristic is 30%, Hans.
Yeah.
So where does that sit with you? Scary? Too small? Too much?
No, that's good. I mean, like that. I mean, if I think about how I structure a typical, let's go to IBC policy, right? This is for IBC purists. This is not a perfect parallel, but generally, when I look at a policy structure, I'm balancing the base premium and the PUA premium, and typically it's around that. It's around that amount. Like 30% of my premium, I think, is a really healthy chunk of base premium that sets in the permanence, it sets in the guarantees, it sets in the floor. But then I have it's not that the PUA is speculative, but the PUA is it's in place for a different reason. And this is a very loose parallel here. I'm kind of thinking through on the spot, but like, I like having a large chunk, about 70% of my premium, going towards the type of, the type of premium that generates cash value that I can use and deploy right now. And as I've talked about with my system of policies, my policy is our investment and growth policy. So pretty much every dollar that I put into my PUA on my main policy is intended to go be invested in growth. So if I just take my policy as a microcosm, yeah, about 30% of it is towards the guarantees and the safety, and about 70% of it is with a step in the middle, like going through this filter, meant to go be deployed and to grow and to outpace inflation. So I kind of, yeah, that 30% does resonate with me. I'm not a
And
purist.
here's where it gets really cool because people are going to say, why? Look, where I'm citing the Ernst Young study, I'm starting my example, my empirical evidence of the plans that we've done. Maybe it's 40, maybe it's 50, maybe it's 15. It can't be zero. That's the point. Why can't it be zero? Here it is. Here's why all plans, all market plans, all market only plans fail. Said positively, you always want to be positive when we talk positive. A successful plan demands, a successful plan must have a mechanism to prevent you from selling unrealized losses.
Yeah.
That's it. That's the whole ballgame. Because what is the S&P 500? The S&P 500 is a phenomenal wealth building tool that over a long enough period of time is indexed to human innovation, is indexed to the economy, is indexed to human growth. I want that. I want as much of that as I can get my hands on. It only works though if you're never a seller. how do you become a never a seller of equities to have something that never goes down elsewhere? That's exactly what I'm, excuse me, why I see all equities plans fail. And the positive way to say it is a good plan needs a mechanism that you never have to sell, never have to realize losses. That's the ball game. Probably stop recording for crying out loud, but I'm going to go way deeper on the S&P stuff in a minute here. But
Yeah. Well, can you just refresh real quick the Ernst Young study you're referring to slash Wade Fowle's work and slash Tom Wall, who are both doctorate level retirement planning like strategists or like they're if you could sum up in 60 seconds what they're how they position the role and how it relates to that Ernst Young study. Can you just sum that up for the people that aren't tracking when you just say the Ernst Young study?
yeah, I'll do the Ernst Young study, but I'll try to English it all up for those heavyweights, that people that I look up to in our field, people whose research I read, who informs the way I speak. So Tom, Wade, if you're listening to this, thank you for what you do. Right. The Ernst Young study basically takes a whole series of portfolios from 100% stocks to 100% life insurance and says, oh, you will actually create more wealth by, and they use insurance and annuities sort of largely interchangeably, right? Something with no risk. You actually will create more wealth across every spectrum by adding no risk assets to your worldview. And I think the peak was 30 or 40% in their study, right? 20 is too low because now I'm linking it to Wade Fowle. Wade Fowle's work says anything more than 3 or 4 years of a risk buffer is probably too much because you're giving up too much growth. Wade Fowle's put out some literature on that. And Tom Wall has done some amazing work about how annuities just increase total income. And so that's how it all coalesces, Hans, is this idea that if you overdo the riskless stuff, you give up too much growth. It's actually too expensive to do. But if you have only growth stuff, you have to dip into it. So that magic number is 30% based on the Ernst Young study. Just under 4 years is what Wade Fowle's work says. And Tom Wall's work says, yeah, look at life insurance as a bond proxy and look at annuities as income, but not your only source of income. And that's how it all kind of clicks, Hans. Right?
What about
Because a
that, the
great plan.
withdrawal, like that specific and I guess this particular Tom Wall's book, but if you take this 30-year selection of the market and you pluck out the worst 3 years of performance in the market, if you could go back and do that, and instead of taking those losses and withdrawing when the market's down 30% that year, wasn't it, if you could pluck 3 years out and swap them, your living expenses funded by your life insurance policy, without having to take those realized losses, you skyrocket the rest of the portfolio because it doesn't go. You basically, it's like, how can we trim off those bottom few outliers from the sequence of return risk?
That's
Sequence,
all it is.
I guess.
The modern game is that the 4% rule came from, I think, Ted Benning in 1998 published it, and that just became the gospel because the AUM guys needed something to keep the assets. But it's basically been debunked at this point with guys like Wade and Tom and David McKnight's newest book, although he's a fan of IUL, which I'm not. It's called, I think, The Secret Order of Millionaires, where he says the whole point of these assets is to make sure the other assets do what they do. A good plan, a good plan eliminates market losses from being realized. That's all that we're talking about. So where does this sort of click? Yeah, because you're right. Tom Wall's book is fantastic. If you just take out those 3 worst years, not because you control the S&P, but because you had something else, you get it all back and then some. Very few things beat the S&P in terms of creating wealth. It just has some challenges for retirement planning. That's what we're trying to say. No one here is anti the S&P. The cool dialogue is what role does it play? Why is it so damn hard to beat? So why you should just probably think about indexing. But you know, average returns don't matter when you're pulling money out. Average returns matter on
Right.
the way up, and even then they don't matter because
Yeah.
Buffett has sort of disproved that by sitting on decades worth of cash at a time and waiting for a dislocation. So yeah, that school of thought just doesn't work, man.
Yeah. Agreed. Um, okay, so you were going to talk a little bit more about the investing element, right? The S&P, how
Yeah,
that.
so we'll talk about it briefly. I mean, I could go on for 7 hours on markets. I've been doing that for 2 decades, but my view of the S&P is it's a phenomenal accumulation tool. It's a terrible distribution tool. That's what we've been talking about, right? It's a terrible distribution tool because you don't know what it's going to do, and that's why you pair it with life insurance. What's so interesting about the S&P is there's only been one 20-year period where it didn't have a positive returns, and I think 5 rolling 10-year periods since inception of the S&P The modern S&P, I believe, was created in 1926, but there's an amalgamated index to the late 1800s, where if you took every rolling 10-year period, so that's like 1880 to 1890, 1881 to 1891, 1882 to 1892. If you took rolling 10-year periods, there's only been, I think, 6 or 7 instances where the 10-year didn't return a positive, didn't have a positive return. So odds are you're going to make a lot of money buying the S&P, and you should. We've already talked about selling it when it's down is how a plan gets killed. The real cool part about it is what are you doing? You're buying American innovation. You're buying American companies. And last I looked at, 47% of the S&P's earnings came from abroad. So it's largely a global index, right? This is the hardest part about when I was a CIO and trying to manage money. And the coolest part about working in the ultra high net worth space is many of them didn't even care about what the S&P was doing. I ran an idiosyncratic, that's a fancy way of saying single stock selection model, on only dividend growth stocks. Remember the first thing we said was surety of income. There's largely 3 data sets in the public markets about dividends. There's the dividend achievers, which has paid and raised the dividend for 10 years. The dividend aristocrats, which have paid and raised the dividend for 25 years, and the dividend kings, which have paid and raised the dividend for 50 years. So what I was doing, and I still do this for my personal portfolio, is took the dividend aristocrats, roughly, I think there's 68 or 70 of them now. Apple just became one. Microsoft will be in 2 years, become a dividend aristocrat. A lot of them dropped off in '08. All the financial services companies that cut their dividend, all the banks got removed from that index. Interestingly enough, the S&P was a dividend aristocrat until 2008. It was a
The
very
S&P?
good, sorry?
The S&P?
Yeah, the S&P was a dividend aristocrat until 2008. The financials became, I think, roughly 16% of the index, which is very high relative to its mean. Because right now, tech is like 42% or 43% of the S&P. Most tech companies don't pay a dividend, right? Tesla, Nvidia, all those, the Magnificent Seven, though Apple does, Amazon does not, et cetera. And Google just initiated one 6 quarters ago. And so the S&P was a very good proxy to just go buy the dividend aristocrats. That's failed in '08, and I believe in during COVID, enough of them. I'd have to double check that data set, so I don't get quoted on that. And so what I do with the markets is look for an inflation index cash flow stream by buying dividend aristocrats. That's my favorite way to interact with the market. And there's dividend aristocrat indexes out there, so you don't even have to pick individual stocks. But now you're getting the growth of the markets, that surety of it, the high probability income from dividend growth. And here's what's super cool about that. Dividend growth stocks, especially aristocrats, have at least historically, and this means literally the inception of the data set, have paid and raised a dividend faster than inflation. And I think 7 of 10 Berkshire's biggest holdings are dividend aristocrats: American Express, Coca-Cola, Procter and Gamble. Just go down the list, right? And Johnson and Johnson, which he doesn't own anymore, but Johnson and Johnson has paid and raised a dividend at an average clip of 9.2%. They're getting a 9%. You're getting a 9% raise every year you hold that stock. Whoa.
Yeah.
Okay, you want the mind F moment now? How deep I think about this stuff compared to like just the AUM guys and just the insurance guys? What's the magic number in all of life insurance? What's the magic number, Hans? You don't know this. We didn't prep for this. What's the magic number? To me, dividend paying life insurance has a magic number associated with it.
You talking about just like the internal growth or what? I'm not sure whether.
Yeah, no, it's a ridiculous question. I'm just forcing a premise down your throat, right? So it's ridiculously unfair to you. I've always viewed dividend paying life insurance, the magic number is 8. 8 is the highest cost to borrow in a policy.
Oh, okay,
I
okay.
know that I always have access to capital at 8% or cheaper.
Yeah.
So if I'm building a portfolio of equities or other assets, I want to make sure my yield on cost is always 8% over time. So you can buy
And
Altria. Go ahead.
and what he means, what you mean, the max policy loan interest rate contractually is 8%. Yeah.
Right. And so if I'm buying stocks yielding 3 or 4 or 5%, it'll take 10, 12, 13 years for them to be yielding, maybe a little bit more than that, to be my yield on cost. Meaning I put 100 grand to a stock and it's spitting off 3,000 of dividends. It'll take a while for that same 100 grand to be yielding 8%. Now the 100 grand may have gone up to 200 to 300 to 400, but I care about my yield on cost when I'm planning. Because if I know my cash flow stream can always service the interest only portion of the loans, I've frozen my debt, I've fed my policies, and then I let the market do what it does. I've turned it into a call option that never expires. I'm capturing that rolling 10-year period that I talked about earlier. I'm capturing the innovation, the ingenuity that is American capitalism. To me, that's the coolest way to think about how these two assets intersect, is getting my yield on cost above 8%. I am now agnostic to the amount of loans I have because I always have a mechanism to pay them back. I'm not going to run out of money because I have the life insurance, the annuities, and I get the upside of the market. It takes a long time to do this. It doesn't have to be huge. You can do this on $1 million. You can do it on 100 million. But that's how I think about retirement planning. So let me start over. An inflation indexed cash flow stream, the indefinite upside of the market, and the security of life insurance and annuities in the right proportion.
Just can you do a quick walkthrough, like step? Just okay. I take out a policy loan, just for people that are kind of like just that sort of went over their head. I take out a policy loan. I buy, say, Johnson and Johnson stock yielding 9%. Like just
It yields about 3, or just under 3. The 9% was the raise. So let's go back to that. You're right. If I buy 100,000 of Johnson Johnson, okay, and it's yielding 3%, I'm getting a $3,000 dividend. Cool. 3% of 100 grand.
okay.
Assuming the stock goes nowhere, historically Johnson Johnson has raised the dividend around 9%. The following year, I will get $3,281 instead of the 3,000. That's 9% of 3,000. The dividend growth rate, not the yield, the actual cash flow that the company spits off to you as the shareholder has gone up around 9%.
Okay. Okay. I was thinking you were saying you take out a policy loan for 100 grand, invest in Johnson Johnson. You at most you pay 8,000 to the insurance company, and you make 9 from Johnson and Johnson. But 9% of the growth
Right. So
rate.
what I'm saying is right on the dividend. So once that dividend is spitting off 8,000. Once that investment is spitting off 8,000, my max loan is 8,000. Boom. The whole thing sings. Everything dances because now
Okay.
my dividends can freeze my debt inside my policies.
Okay. I'm
I
glad we
don't
clarified.
mind carrying debt inside of my policies. I mind because the fundamental equation that in infinite banking and life insurance is arbitraging. The fundamental equation we are arbitraging with life insurance is to earn compound interest and pay simple interest. The system breaks when you earn compound interest and pay compound interest. That's why focusing on yield on cost is so important to me when I'm adjudicating my assets and designing my personal plan and plans for my clients.
Yeah. That's okay. Yeah. And that makes the more
I
I
love it. I love when I get you to go, yeah, wait, because we've done this. That's how I know it. This is a new, a differentiated way of everyone's talking about the same stuff. I'm just trying to talk about it in a way that's a little more relevant.
I asked you this last time. Do you have so that example you just walked through? Do you have a visual, a way that you present that to clients? Like if someone sits down with you and says, like, "Hey, I kind of got what you're saying, but I want to see it drawn out," or is that part of the process? Like if someone's working with you for retirement planning, are you going through if we do this, then we can do this, and like is that part of it, or is this just kind of how you run yours and owner's asset does its own, kind of a separate? Like, is this part of your overall comprehensive client offering? This kind of discussion?
The discussion certainly is. The actual modeling, like I have my Series 65, but we're in the process of launching our RIA. But this was the type of dialogues I was having at other organizations, right? Because the other way to think about it, forget life insurance. Let's say you hate it, you hate annuities, not for you. If 4% is your sustainable spend rate, why not just go build a portfolio that yields 4%? So let's make the case completely onerous against us. Let's make the hypothetical impossible. You hate life insurance, you hate annuities, and you hate bonds, and you hate real estate, and you hate private equity, you hate VC, you hate it all except for stocks. Cool?
You're Dave Ramsey.
Right, except for stocks. That's the only thing to buy. Great. You can go buy the S&P, which is currently yielding 1.03%, and now you have to make decisions about how you're going to generate income. Because people think, oh, I just go sell some S&Ps. No. You're making 3 decisions simultaneously. You're deciding what to sell, when to sell, and how much to sell. Or you could go build a dividend growth portfolio yielding close to 4%. Hard right now with the market's overvalued. But you would go buy Altria yielding low 6s, right? Which is also a dividend king, by the way. There's a handful of wonderful names out there that are yielding 3.5 to 5%, right? Brookfield Infrastructure is one. It's a Canadian-based company that does a lot of there's really cool ways to do it. So, well, I want my 4%, so why not get it all from dividends and then the remaining portfolio grows? That's all I'm trying to say is focus on income from the markets, focus on income from annuities, focus on income from all the things you do with your money and planning becomes a whole lot easier because you remove timing, you remove emotion, you remove behavior.
So what's the timeline on this RIA? Because I feel like this is not what people are getting, and so I think hopefully if you're listening, you're like, this is a way, like the way that Ro's talking about how we think through retirement is so much more uh like it's so much more rich than just save a pile of money. And so I know we primarily what you're doing right now is working with business owners on getting the pensions going, the Re-pensioning America, the cash balance plan. But is the RIA something that you're doing on just on a small scale, like for your network, or is it like are you going to have advisory services along these lines? And do you need an
Yeah, we'll figure that. I have thoughts on that. I want to go back to two things you just said that were really fascinating. Then I'm going to answer them. I'm not trying to be terse. That's a so what you said. This is what people want to talk about retirement. Again, we don't. You neither you nor I think about it as retirement. I want freedom. My clients want freedom. If you're free and then you still choose to go back to your 9 to 5 or choose to be an entrepreneur, or continue to scale your business, fine. You operate differently when your basic needs are taken care of. That is the most game-changing phenomenon my clients share with me. Life got easier when I knew I wouldn't lose my home. Life got easier when I knew I'd always eat. Then it was just this wildly, and for lack of a better word, wildly erotic intellectual exercise that they all got to go through. They became better lawyers, better entrepreneurs. So it's a rich discussion because it's actually about freedom, not because it's about retirement planning. I wanted to clean that up from earlier because that's really huge. That is the core fundamental belief. If you're sprinting to retirement, you have nothing to retire to. You're retiring from something, you will still not be successful. Bold statement. Don't care who comes after me for that. If
Yep.
you are not retiring to something, you're in a lot of trouble. Okay, the RIA. TBD on the timing, if at all, but that's really not the point. You know why this is such a really hard thing to do in practice? Let's say I just packaged it the way I did, and we all want to do this. You are when you structure portfolios this way for income, for surety of income, for inflation index surety of income, which is my most fun favorite way to harvest the market, to harvest the factors that are inside the market. There are long, not small, not short, long bouts where you underperform the S&P 500. It takes the right kind of client. For me, it's going to be harder to find the clients that fit my philosophy than the other way
Yep.
around. The S&P right now is approximately 42% tech, yielding 1.06 or 1.08%, right? If you are not overweight, either the S&P itself or Nvidia and Netflix and my, Tex and Micron and Amazon and all that, you're underperforming. Everyone talks about how Buffett's underperformed for a decade now. He's retired. Greg Abel's running the show, but it's really hard to run a business this way because you're fighting human behavior.
Hmm.
Candidly, I'm not sure if that's the only strategy we'll deploy. It's my personal strategy because all I care about is that my income goes from the bottom left to the upper right on the graph. I don't care what the S&P is doing. If you could find me those kind of clients, great, but that's why this is really hard because because it takes such a different mindset. You lose the ability to brag at cocktail parties.
Mm.
That's gone.
Yeah.
This says the math is so simple here. Go to suredividend.com, go to any of the dividend aristocrat studies over very long periods of time. They do very, very well. 42% of the total return of the stock market of the S&P since inception has come from income, not price appreciation.
Wow.
But
Say that again.
but
Say what it said.
42% of the total return of the S&P since inception, it's gone down to about 40 now, but 40% of all the money you made in the market has come from dividends on the S&P.
Yeah.
60% from price appreciation. I'm actually going to Google something because there's this landmark study that came out about what small percentage of the S&P stocks have actually contributed to the S&P's gain. And that's why individual stock picking is very hard. It's called the Bessembinder study. So we should all look it up. But do stocks outperform treasury bills? It was in the 2018 Journal of Finance. I remember reading the study. I just forgot the name. Bessembinder, Bessembinder, it's an insane study that shows only a small single digit percentage of stocks in the S&P have contributed to all of the S&P gains. So all the companies that went under, all the companies that underperformed. So indexation works. The dialogue I'm dying to have with people is I want to tell them indexation works, but I want to say you can also index to dividend growth. You can index to the things that matter to your life. That's what I believe in what I'm doing. Maybe I'm wrong. Maybe I'm weird. Maybe I'm a pariah. But I want my checks to come in. I want my checks to go up. And then I want to have a good place to put those checks, life insurance. And I want to do interesting things with that money. Live my life,
Yeah.
travel, see the world, take risks, whatever. But that's how I think about money and planning. This episode, of course, classic you and me, has gone on way too long than the 30-minute barrier we set.
Oh, yeah. I mean, I knew. I pay lip service to it, but I know I can't do it in 30 minutes.
Yeah,
But
me neither. When you and I get jamming. So let's do a quick recap. Unless you have a question. Sorry, you're about to jump in, boss.
it just the thought that, you said, like, I don't know who this is for, or people, it's hard to find the right client. I think generally someone listening to a podcast that's generally about whole life insurance probably is a good filtering mechanism where they might be more likely to have the tendencies of long range thinking, ability to kind of think beyond just rate of return. So hopefully, there is some overlap there, like with our audience and our client base. I think that this is retirement planning that would resonate with them. I think that or at least I'm using myself as kind of an aggregor for our entire audience, just because we put out our thoughts. And so, and I've gotten a lot of people that say, yeah, I agree with how you present this stuff. And so let's just say the conventional financial planning model falls on deaf ears with us. It just falls flat. It doesn't stand up to scrutiny. And so that makes it hard to just take the concept of retirement, the concept of qualified plans, the concept of rate of return. It's like, it's hard to not throw all of those babies out with all that bad bathwater, right? And at the end of the day, there is some value in these concepts individually. It's the order of operations that's not that I think is off, and I think it's the overemphasis on certain elements. But still, there is value in retirement planning, even if I don't believe in 65. There is value in having an aggressive, growth component, even if I don't believe that rate of return is the only thing that matters. And so finding this middle ground, I think, is what people should be looking for in retirement planning. So when you do open up the RIA, if you do start doing this, I think you would find a pretty pretty good listening audience from our client base. And I think that you have to have, if you have YOLO FOMO, this is
Yeah.
not going to work for you, right? Because we're talking decades, and you just have to be like, and I made that case recently where I'm like, if you feel like you're just watching the market go like this and you're just missing everything right now because you have some semblance of a break on speculation, because you have this safety component, like, relax. Like, if you have, that you don't need to just worry about every single all-time high. I'm missing out, like, there's value in having dry powder. There's value in the way that we position it. But I think you bring the right mix of the approaches here, and having a foot in both camps, so to speak.
Yeah, it's a super low ego way to think about money, right? And it takes a unique mindset and discipline. And you have to be willing to consume the trade-offs, right? The trade-offs are you may not get to the biggest number, but if you want to make sure you're getting your checks, the highest probability way to get your checks and still get the growth, it's a cool way to think about money. Now, there's plenty of non-dividend paying stocks that I adore, that I follow, that I own personally. So everyone hears something, and in the podcast community is always like entrenched in either or. I'm just trying to give a framework for how to attack it, right? Because remember, what were we actually talking about? Retirement planning is income planning. Retirement planning is not net worth planning. And so once you sort of say, okay, there's this money, I'm going for a high net worth. I own my own business like you do and I do, right? I'm going to consume liquidity for real estate. We know a lot of real estate guys, right? But there should be some of your assets that you're saying, oh, I'm doing income planning with I'm doing risk planning with these assets, because they're not mutually exclusive. Because I own the S&P and I own non-dividend paying stocks as well. But the overwhelming majority of my money is designed to get me to that freedom lifestyle. Whether that's, for me, is 5 grand a month. For some people, it's 50 grand a month. Whatever it is to you, let's just tie this all together. You either need the 12x or the 25x heuristics to help you figure out what it is. And someone should make you aware of the trade-offs of each. That's it. That's the whole dialogue. And then it's very personal after that. It's about risk tolerance and insurability and legacy or not. But I know the point of the story is a plan is not a plan if you risk running out of money. A plan
Yep.
is not a plan if you have to sell unrealized losses. And also, a plan is not a plan if you could be subject to the vagaries of inflation.
Yep.
And so that's the both schools of thought from my perspective, trying to coalesce them together as best I can. And then where you are on that spectrum, if you want an answer, shoot for 30% in risk free, but that number could be 80 for some people. That number could be 10 for some people, right? But plan's not a plan if you don't inoculate sequence risk, and the plan's not a plan if you don't inoculate inflation risk. That's everything I know, Hans. That's my entire knowledge base.
Yep. And I would be remiss if I didn't add the plan is not a plan when we're talking about retirement if you don't have a contingency for if you don't make it. We had last week plane crash, Air Force Base in California. We lost one of the members of Brian and I's group. 40 years old, 3 children. Not sure the life insurance situation. I'd had conversations with him before, but how we present it never resonated. And I think that at a minimum have the term in place when you're doing this, but I think that never assume you're going to make it to 65. Whatever 65 can be irrelevant, but never assume you're going to make it to that point. And have the contingencies in place. I have to, just as an insurance guy, I just have to put that, always front and center. If you don't make it there, make sure your wife can make it there without you. So retirement is the freedom to do what you want with who you want when you want it, when you get there. And so I think
wherever you want is the last part. That was his famous quote. So yeah. Hans, this has been great. This is everything I know summarized into the 2 schools of thought. Obviously, we'll go deeper if I'm fortunate to come back and be a contender for the Gold Medalist Guest Award. But I think I've had so many conversations about this with so many people across the entire wealth spectrum, and people aren't just have a dialogue about 12 and 25, pick an age, don't wed yourself to it. But that's where it all starts. And then, okay, how do I ensure? Because people's biggest fear is running out of money before they run out of life, or people having a downgraded lifestyle in retirement. And so then you solve this with this combination approach, and you're good to go after that. It doesn't need to be the hardest thing in the world. Do you know why it is so hard? Man, the emotional trade-offs are enormous. If you went all annuities, Hans, you're telling someone their wealth will never go up.
Yeah.
That's why you add some insurance, because your wealth does go up. But if you tell someone they want the biggest number they can get to, and they eschew insurance and annuities, and they don't go with that, they're going to be constantly living in fear of a bear market of sequence risk. So the reason it's hard isn't the math. The reason it's hard is the emotion. Yeah. Big trade-offs in both camps. Big trade-offs in both camps, man.
You mentioned it on our first episode and on several that I've heard you on recently. The studies on the lifespan of people with annuities, like that's fascinating. Just from a psychological.
LIMRA, I think it was 2015 or 2016. LIMRA came out with a study that people with annuities tend to live a little bit longer, which is cool because you're not worried about your next paycheck. It's always coming in forever. You can't outlive an annuity. In fact, the longer you live, the more you're beating the system, right? So you want to beat the system. And then there was I think it was 2005 or 2006 in Wall Street Journal, an article entitled "Friends, Neighbors, and Annuities," and it was at that intersection of like a high social network with guaranteed money are the happiest retirees across the board. It was so cool because humans are fundamentally social creatures, right? And so when you don't have to worry about money, your stress level goes down, and that's why you live longer, because your immune system and your neural pathways aren't being shred by high cortisol levels, high anxiety at all times. It's fundamentally human to know that you're going to be okay from the external forces, right? And then it's just about what you can do by conquering the self and finding happiness outside of money. Yeah, your lifespan. Yeah, the LIMRA and the Wall Street Journal pieces were really, really cool. For me, super eye-opening as I spent the last 4 years studying this side of the business, 20 years on the traditional wealth side, now going on just over 4 years of insurance, trying to blend the 2 schools of thought. Is my goal, is to take the best of both worlds and hopefully help some folks.
I love it. Well, I think this is an awesome conversation, and down the road, if you need an IAR, I'll be there by the time you're spun up. I'll be ready to go. Let me know. Putting you on the spot there, but yeah,
all good.
Thanks for coming back on.
Thanks for having me on. I hope this was helpful to folks, and yeah, thanks again, Hans, for having me.
Awesome. All right. Cheers, everybody.
Cheers.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.